Hello everyone, my name is Seeba and I would like to thank everyone for watching our video here in CurrencyHacked.com. In CurrencyHacked.com, we've been giving you the video related to the investment, business, and the finance, which will help you to make a better decision either in the investment field or in the business field. From the last few weeks, we've been talking about the intelligent investor. If you don't know about the intelligent investor, investor was written by the Benjamin Graham, which we respect. He's very respected person in the investment field, and we think that the intelligent investor is the most read book if an individual wanted to jump into the investment field, because of the fact that we think that to become so intelligent investor, they must have a good temptation, and they must have a good um, a policy to follow, and they must need to take a rational decision, and the intelligent investor will talk about the everything. So that's why if you are interested on the other chapter of this book, you can always go to our previous video. We have some more videos on our YouTube channel Currency Hacked, and you can also follow us on Facebook, and like us on Facebook, follow us on Twitter, and join us on the LinkedIn. um, in today's videos, I'm going to talk about the chapter 6 of the intelligent investor. uh, you can if you want more article related to the finance, you can go to our website www.currencyhack.com. And as I've already told you, I'm going to talk about the chapter 6 of the intelligent investor, a portfolio policy for the enterprising investor, negative approach from the intelligent investor by Benjamin Graham. Currency hack. You are watching this in Currency Hacked, obviously. This is our website. If you want to contact us, you can send us an email at info@currencyhack.com, or you can always go to our website www.currencyhack.com. um, this is our motto over there. And then before I move forward, never I need to tell you that you never invest the money that you can't afford to lose, because investment is the risky field. I mean, there is a risk in the investment. So make sure that you don't put your emergency fund or other kind of fund in the investment, because there will be the always possibility that you can lose your part of the the principal, or you might lose all of your money. So always do your own research before investing cryptocurrency and other kind of shares. Cryptocurrency are subjected to high risk and high volatility. And if you want our slides, if you want to download our slides as well, also you can go to the slideshare.com and you can get our slide. So let me move to the another slides. It's me, Siva Pandare, and I'm chief editor at currencyhack.com. If you want to contact me, you can send an email at siva@currencyhack.com as well. So um, this is the chapter 6, portfolio policy for the enterprising investor, negative approach. And let me read this paragraph here. The aggressive investor should start from the same base as the defensive investor, namely a division of his fund between a high-grade bond and high-grade common stock bought at reasonable price. He will be prepared to branch out into other kinds of security commitment, but in its cases, he will want to well-reasoned justification for the departure. It means that the if you don't know about the enterprising investor and the defensive investor, you can watch our previous video where you can learn about the defensive and the enterprising investor. The According to the book, enterprising investor also start from the like this is the defensive investor. He sorry, my phone. Let me, sorry about that. He will be start like the defensive investor, and then he will be it means that he can he can split his investment either in the either in the bond field or either in the stock field. But at the moment, we can see that also we are not researching about the bond, so we cannot tell you, something buy this bond or something like that at this moment. But but what this book trying to tell you is that the first initially you can buy the something like the high grade stock, something like the bank stock in the reasonable price. And after that, when you continuously grow your education, after that you can jump into the enterprising investor. It means that the negative approach. So let me move to the another slide here. uh, Second grade bonds and preferred stock. Mm, um, it uh, uh, According to this book, the second grade bond and the preferred stock, he's referring to the, we think, the junk bond which was selling on 1980 or something like that. And let me read this paragraph here. Throughout this book, we refer to the possibility that any well-defined and the protracted market situation of the past may return in the future. Hence, we should consider what policy the aggressive investor might have to choose in the bond field if prices and yield of high-grade issues should return to the former normal. Let me go to another paragraph here. So, uh, in this book, the Pengram is trying to tell you that if we wanted to buy a second grade bond or something like the preferred stock, I think we cannot see the uh, at this moment we can't see any second grade bond and preferred stock. Most of them are already gone. So. mm Let me go to the another chapter. So I'm not going to talk more about the second grade bond and the preferred stock over here. Okay, let me go to the another slide here. Second grade bond and preferred stock continues. Many investors buy security of this kind second grade issue because they need income and cannot get along with meager return offered by a top grade issue. Experience clearly shows that it is unwise to buy a bond or prefer which lack adequate safety merely because the yield is attractive. Here the word merely implies that the issue is not selling at a larger discount and thus does not offer an opportunity for a substantial gain in principal value. With such security are bought at full price. This is not many points under 100. The chances are very great that at some future time the holder will see much lower quotation. It means that if the investor wanted to buy a security second grade issue, or maybe the second grade bond, he can buy them in the the substantial discount, or he like it means that they will need a lots of education and the art, we can call the art, to exploit to buy the the second grade bond and the preferred stock for the enterprising investor. uh, so if the investor buy the this kind of a bond or something like the second grade bond or the preferred stock in the full price, they might see the substantial loss in their principal value, because they can fluctuate very, they can fluctuate in the large direction, either in the the either in the bull direction or the bear direction. So let me go to the another slide here. All investors with even small experience know that foreign bond as a whole have had a bad investment history since 1914. This was inevitable in the light of two world wars and an intervening world depression of unexampled depth. At very few years, market conditions are sufficiently favored to permit the sale of some new foreign issue at a price of about par. This phenomenon tells us a good deal about the working of the average investor mind, and not only in the field of bond. So um, uh, regarding to the foreign government bond, he's trying to tell us that the foreign bond government might not be good. Whether you might live in the USA or you might live in the Australia or whichever country you are, it means that the first you might want to see the bond from your country, because there will be the lots of cost involved, plus the foreign exchange and the some other things. uh, Let me go to the another slide here. new issue generally. We This is quite interesting that the new issue generally, it means that the initial public offering. We can see lots of people are buying the initial public offering IPO or new issue. They are selling in the, I mean, like in the favorable price for the seller. It means that it might not be bargain for the buyer. um, let me read this paragraph here, and after that I'm going to describe about it. It might still seem ill-advised to attempt any broad statement about new issue as a class, since they cover the widest possible range of quality and attractiveness. Certainly, there will be exception to any suggest rule. Our own recommendation is that all investors should be wary of new issue, which means simply that these should be subjected to careful examination and usually severe tested before they are purchased. Two are two There are two reasons for this. Sorry, I wrote it wrong. There are two reasons for this double caveat. The first is that new issue have special salesmanship behind them, which calls for a special degree of sales resistance. The second is that most new issue are sold under favorable market condition, which means favorable for the seller and consequently less favorable for the buyer. We can give you the example of this. In 2017, there is a initial ICO, initial coin offering in the cryptocurrency, and we did see lots of the cryptocurrency, which was buying and selling in the highest price, and after 1 year most of them was collapsed. um, and then the buyer lose uh, lots of capital which they have put in the initial coin offering, or we can see some other example of the IPO, initial public offering. We think that the investor can see the stock which is already listed in the stock exchange, and where they can buy the margin, which they can get the margin, because those business are already established, and then they will have a reasonable chance to recover from their depression, and we can see the it means that we can see the we can see the reasonable speed. We can see the recover in the price in the reasonable speed, where for the new issue, obviously the new issue can go speculator high in the first days or 2 days or in the first week of the listed. But we think that without seeing the balance sheet and the income statement or something like this, compared to the compare I mean that if we see as a average, lots of the people going to lose in the initial public offering than the gain in their investment. So let me go to the another slide here. New common stock offering, it's continues. I'm going to talk about continuously the heedlessness of the public and the willingness of selling organization to sell whatever may be profitably sold can have only one result: price collapse. In many cases, the new issue lose 75% and more of their offering price. The situation is worsened by the aforementioned fact that at bottom the public has a real aversion to the very kind of a small issue that it bought so readily in its careless moment. Many of these issues fall proportionally as much below their true value as they formerly sold above it. So it means that the lots of the IPO can lose their value issue lose 75% or more. And then the intelligent investor, we believe they can buy those kind of stock after 1 or 2 years when they get the bargain price, and then when they after they see the fact of the balance sheet, or the the income statement, or some other fact things about them. So that's the one recommendation from our side as well. Let me go to the another slide here. New common stock offering continues. An elementary requirement for the intelligent investor is an ability to resist the blandishment of salesmen offering new common stock issue during bull market. Even one or two can be found that can pass severe tested of quality and value. It is probably bad policy to get mixed up this sort of business. Of course, the salesman will point to many such issues which have had good size market advances, include some that go up spectacularly the very day they are sold, but all of this is part of the speculative atmosphere. It is easy money for every dollar you make. In this way, you will be lucky if you end up by losing only two. So it means that in the first day or in the first week or maybe first month of the listing, the stock can go spectacular high. We can give you the lots of example. You can see the some internet stock which was listed between 1995 to 2001 or 2002. They have increased speculative, but in the 2002 they have lost their value, more than 75% or more. Most of them lose then 75% or more. The intelligent investor, we believe, they can buy this kind of company in the bargain price when they get the bargain price on 2002, if they believe in the good company. So instead of buying the in the first week or in the first day of the IPO, they can buy the in this in the very cheap price. Often they can get the 80% discount margin on the stock if they wait few years, let's say 7-8 years or maybe 5 years. So that's the one recommendation from our side as well. So let me go to the another slide here. New common stock offering continues. While the broad aspect of the stock market behavior since 1949 have not lent themselves well to analyze based on long experience, the development of new common stock flotation process exactly in according with any prescription. It is doubtful whether we ever before had so many new issue offer of such locality and with such extreme price collapse as we experienced in 1960s, 1962. The ability of the stock market as a whole to disengage itself rapidly from the disaster is indeed an extraordinary phenomenon, bringing back long view buried memories of the similar invulnerability it shows to the great Florida real estate collapse in 1925. It means that we can learn from this the paragraph as well that there was a big issue offering in 1960s and 62, and those are the collapse. And another example I've already given you on 2000 1995 to 2002, say 2001 or 2. And we can see a recent example of the ICO initial coin offering. You can research about them in the internet. Let me go to the another slide here. um, uh, New common stock offering continues again. Must there be a return of the new stock offering madness before the present bull market can come to its definitive close? Who knows? But we do know that an intelligent investor will not forget what happened in the 1962 and will let other make the next batch of quick profit in this area and experience the consequent harrowing losses. So it means that the intelligent investors should understand that the uh, new VC can go up spectacularly in the days of the listing, but after a few month or maybe few year, it will go to its true value of maybe the investor can get the good company in the less price, say 75% in the discount, and they will have a better chance to increase their principal value. So let me go to the another slide here. Okay. I think we finished the chapter 6. So uh, if this video help you to understand the investment and to become a great investor, you can follow us on Facebook, you can connect us on LinkedIn, and you can follow us on Twitter, and you can also subscribe into our YouTube channel. And if you have any question or if you have feedback, you can always send us an email at info@currencyhacked.com.